Hey there, here's a quick note. This podcast contains general financial advice only. That means it's not specific to you, your needs, goals, or objectives, so don't act on the information until you've spoken with your financial advisor. You'll find our full disclosure, disclaimer, and link to our financial services guide in the show notes. Drew Meredith, welcome to this episode of the Australian Investors Podcast.
Glad to be back.
Glad to be back. Where you been all week? What have you been doing?
Sydney, from memory. We had a nice flight cancellation, shifted to the 5 p.m. return flight, and then managed to shuffle our way onto an earlier flight.
Wait, you were going to fly home today at 5 p.m?
9:30 cancelled. They put us onto an alternate 5 p.m. flight.
Wow. Yeah, right. So we're recording this in the afternoon on Friday. We're a bit late to this one, but it's coming out tomorrow. So that means every single thing that we mention in this podcast should be... No, it won't be accurate, but...
Incredibly topical.
Yes, it's going to be topical. But no, we are back for 2 cents. We're answering questions. This is our second Q&A session on the Australian Investors Podcast. We have questions from ethical investing through to some direct companies, a REIT. We've got lithium, a bunch of other stuff, when to invest a lot of money. One weird one that's come through I have no idea about. But we take any and all questions. If you just head to the Rask website, any of the Rask websites, in the menu there's a thing that says ask a question. Depending on which podcast of ours you listen to, you will be able to get your question answered. And extra points for creative names, which we've got a few here. One of them is very familiar to me, so I know who that is, even though they did use their pseudonym. So yeah, we'll just get stuck into the questions. Like I said, if you want to send them through, if we do answer your question, we don't know your personal situation. So any and all information, as the disclaimer would have said, is limited to general financial information only. If you want to get one-on-one advice, you will have to speak to a financial planner, say like Drew over here. And that financial planner will be able to help you out and recommend strategies that are tailored to your situation. We are not doing that on the podcast. Unfortunately, we cannot. So first question, Drew, comes from Aiming Ethical. And on brand, the question is, I would love an in-depth review of DZZF. DZZF being the ETF from Beta Shares, which is a diversified ETF offering ethical exposure. So what that means is it's an ETF with other funds inside of it. So if you think of an ETF like a basket, this is a basket of a basket, because inside of it, you've got 3 different funds. You have an ethical Australian shares ETF, an ethical global shares ETF, and an green bond ETF. I don't know if you know much about this.
I don't, but just brought it up.
Okay.
I tend to, where as soon as it goes to ethical or ESG, I tend to be concerned when it's index. So Beta Shares they'd be investing into some sort of sustainable or ESG screened index, and I just don't think the risks of the ESG and ethical considerations can be covered by the kind of screens that generally go in there. But then I did see it was approved by RIA, so Responsible Investment Association of Australasia. We just got off a call with the CEO of that group, and they're super impressive. They demand full transparency of every fund that they are assessing and continued transparency of their holdings. So when I see that, well, that actually piques my interest a bit more.
Yeah, it's normally a pretty good stamp. Interestingly, when we did a survey on ethical investing, I think it was in the Australian Investors Podcast not too long ago. Maybe it was when I say not too long ago, about 2 years ago. It was interesting because I think at the time it was around about 62% of respondents said that they wouldn't trust something just because it has a stamp on it.
Yeah.
But the RIAA is the kind of leading authority on this type of thing. And of all the ethical ETFs that I follow, I think the Beta Shares, not only are they the biggest, they're also one of the best in terms of their criteria.
Yeah. So
even though everything here is basically negative screening, meaning that the ETFs screen out sin stocks and there's like different thresholds within this ETF. This ETF actively seeks out companies that are doing the right thing as well.
Yeah.
And the idea of DZZF, which is the diversified fund, is it's a direct competitor to the Vanguard funds like VDHG in particular that do not have an overlay. The thing that's good about DZZF is it just offers exposure to Australian domiciled ETFs.
And 90%,
90% growth, 10% bonds. Curiously, when we looked at this at the time, I don't have the numbers right in front of me, I was trying to pull them up before the show. But when we looked at this, the bond ETF, which is BND, yeah. I think there was only one bond at the time in the top 10 that was different to the
non-ESG.
The non-ESG one.
That's the challenge, isn't it? Particularly in fixed income.
And in Australia.
Yeah. And there's only a small amount of issuers.
Yeah.
Yep.
So and the thing is, you can go and get the IAF ETF, which is the iShares Core Composite, which is the leading bond ETF. But the thing that's really good about this is if you invest in FAIR or ETHI, the two equities-focused ones, they cost you more separately than this does in one.
On its own, yeah.
So that's kind of drawing you in.
The only thing I kind of see is whether you'd use this as your only holding, because one of the challenges you have with an ethical or an ESG screen is that it naturally tilts towards certain sectors. So you get a style bias, and you can see the top holdings are 24% in IT and nearly 20% in healthcare. So it's like the opposite concentration of the ASX. With much more in that high growth, the stuff that's fallen off pretty heavily this year. So you might be looking at how do you balance that sector weighting if you're putting this in a broader portfolio, why you might not want it all in one.
Yeah, and the thing is, right, that style bias is currently coming to the fore because
they're underperforming.
They're getting smoked, right? So whereas we're looking at coal stocks and we're looking at iron ore and massive dividends, huge buybacks.
Yeah.
It's
gas and oil.
Yeah. So that is the risk. People are finding, this is the flip side of it. 2 years ago, it was all, rainbows and whatever.
Yeah.
Now it's coal.
Yeah.
So
for the short, I think it's going to be for the short term anyway.
Yeah.
I think you just have to be wary that these things will be their growth. So if it's a bad period for growth stocks and growth styles or fast growing companies because interest rates are increasing, it'll struggle in those periods.
Yeah.
Yeah.
And you do see within the FAIR ETF, the Aussie one, it's 4.2% Telstra. You got a lot of healthcare names in the top holdings there. So
it's not a lot different.
Yeah. And if you go to ETHI being the global, you got Apple still the biggest. You got Home Depot, Visa, MasterCard. To be honest, Drew, I probably wouldn't have this as the only.
Yeah.
I could maybe think about that with VDHG, but not DZZF. It's probably not diversified enough.
Yeah. I'd agree as well.
Yeah. But it is like if you're thinking of this ETF, whoever you are, and if you're just listening and you're looking at an ethical focused ETF and you own ETHI and you own FAIR, well, you could consider this because it kind of rebalances it. It offers, pretty compelling fee load. So not bad. Like out of all the ETFs on the ASX, it was 200 and whatever.
It's not overly expensive either.
Yeah.
It's pretty good.
Yeah. So for a core holding, it could do worse. Okay. Great question from Amy Ethical. Next one is Will Halp, and Halp is spelled HALP. Thoughts on small/mid-cap Oz tech with enough cash runway to profitability as reasonable investments at the moment? ? Some personal favourites in the area are WSP, which is Whisper, RMY, which is don't know off the top of my head. Yeah, and Dubber, DUB. However, don't
RMA Global.
What?
RMA Global.
No, I don't know the business.
Online digital marketing.
I don't really fit the bill, and I do share your views re Dubber. However, remain bullish should they discover the scalability that is mentioned every quarter.
So what's your view on Dubber?
Not good.
I mean, I always think devil's advocate when it comes to this. I'm like, no offense to these companies and who's invested into them, but you can buy Nvidia, the biggest chip company in the world, 60% cheaper than it was less than 12 months ago.
Yeah.
I'm more likely to go buy Nvidia or Alphabet, all these stocks that have fallen 30 to 60%, that have massive global addressable markets, than look incredibly closely at Australian kind of smaller listed companies.
Yeah.
It's just challenging. You need to know a company like that better than anyone when you're investing into it. We all love the story, and they've always got great stories and great products, but you don't know how that, what the catalyst is to finally get that to fruition. Profitability is one thing. It's very hard to predict, and you might get everything right, and then the market goes the other way, and you lose 60 or 70%.
Yeah. I think that's the thing, right? So I don't know. I've mentioned this a little bit the last few weeks. I was chatting to some fundies earlier on this week, and I just lurking. And I found like a lot of people are reflecting currently on their lessons learned from the GFC. And one of the lessons that keeps coming out of it is that they keep bringing up at this time is, my regret back then was not buying high quality companies. Now, that's not to say we're going to have the same market environment as we did then. But during uncertainty is when you get the opportunity to move into businesses that you might not otherwise get the chance.
Yeah.
And so at any one time, I just think you've got to allocate accordingly. And I tend to think that Whisper is an interesting business, to be honest. Its big brother is Twilio in the US, and that's actually down 78% year over year.
Yeah.
12 billion, 13 billion market cap US for Twilio. Whisper, being bespoke in what it does, $85 million market cap.
Yeah.
I can't really comment on the other business, but I don't mind Whisper and I don't mind Twilio in particular. I really do like Twilio as a business. I think the idea of it's a great business. The one thing to note with Twilio is that it shouldn't get the same profit multiple as, say, Trade Desk or some other technology company like Salesforce.
Yeah.
The reason being is its economics aren't as good. Should have just started with what these businesses actually do. Twilio and Whisper, they do unified communications basically. So it's not really unified, but it's basically like if you ever get like you put in your information when you sign up to something online and then you get sent a text message to confirm, like two-factor authentication. If you get a message from Uber when the Uber says, I'm here, and it goes to your phone, that gets sent through Twilio.
Yeah.
And that's a great service because it can be billed on usage and it can be billed into subscriptions.
Yeah.
Really interesting platform model because, and like if you get an email from Rask, like let's say you reset your password or you do something like that, that all comes via Twilio.
Yeah.
And so that's how, as like say
infrastructure. Of the internet, yeah.
Yeah. As say the Rask business grows, we're going to be paying Twilio more and more and more as we grow because there are going to be more emails, there's going to be more transactions.
Yeah.
So that's the basic use case for it. And I think it's a really good business. It's just that the economics, it works out that the margins aren't as good.
Yeah.
So if I was looking at Whisper, the thing that I'd be looking at right beside it is Twilio. And to be honest, Twilio is I think it's an impressive business. I don't, will help. I know you've got some of my views on Dubber. It's just one of these businesses that I think it needs a management change to actually pull back.
Great concept, like incredible. Yeah. So many good concepts. I mean, what we've always probably said in here in the past that most of our clients are retirees. So when we look at these type of assets, we actually think this is an area in the market where active managers can add significantly. So they can get better access to management. They can ask when people are being pushed out or ask for them to be pushed out if that needs to be done. So we tend to find a microcap or a pre-IPO investor that can get access to the placements. A lot of these companies are raising capital. So if you can get access to a placement or a pre-IPO, you can get it cheaper than what's on the market in a lot of the time. So we kind of use that within portfolios. And it's, proven small companies and microcaps are where active managers have actually consistently outperformed compared to large caps.
Especially here in Australia.
Yeah. But there's so much information asymmetry in this market.
Yeah. As much as ASIC didn't just hear that.
Well, you can just it's like a small business. They're listed, but they're still acting like small businesses.
Yeah, that's it. And some of them only have 30 employees.
Yeah.
These are small businesses.
Yeah.
So don't mind Whisper. I think I've just got to do a bit more work. I think Claude Walker from Rich Life has written about it quite a bit. There have been a few others. Lachlan Burgensen on Rask Media has written about it a bit. I think that Whisper's a really interesting business. I don't like Dubber. I think it's got a lot of change that's needed, and I think there's still a fair bit to get unwound there before. If it hits that scalability, if it's just take devil's advocate, if it hits scalability, sure, it's going to be a wonderful investment. It's going to bounce off the bottom.
Yeah.
But for the most part, it's kind of an avoid for me.
It costs money to scale. And it's hard to get money at the moment.
Well, they were lucky. They did $100 million capital raising at peak,
Peak fell.
And they were going to make acquisitions and now they're not doing that anymore. because
they probably should be.
Well, then now would be the time to go and deploy capital if you were interested in that. Actually, that's a good segue into the next, well, not the next question, but an interesting question, which is from Striven Boski. Is that how you pronounce
I
it?
assume so.
Striven Boski says, assuming you're all set up as a sophisticated investor, how does a new investor get access to VC circles and deals?
I think there is actually a loophole, isn't there? Early stage venture capital that retail investors can go into some VC deals at the moment, and not just the possibles and those sort of groups, but you can actually, there's certain strategies that are approved for small amounts of retail investors.
There's obviously the Equitize platform.
Yep.
What's the other big one? I should know something.
Possible is one I've looked at, but I can't remember the. Yeah.
Yeah, because this is where Booktopia raised.
Yep.
Before IPO. It's where a bunch of other businesses have gone, and you can. Sometimes they're tiny businesses.
Yeah.
And I think they can have up to 50 shareholders.
And you get product
before
off
they
them
become
as well. Yeah,
limited. Yeah. And you can. So you can invest. And I remember looking at one brand. It was eco-friendly lipstick. Right. It was a bit out there. Like, let's be honest, it's at the far end of the risk curve. But that's VC, right?
Yeah.
And this was a founder-run business, had a pretty well-credentialed CFO. And when you invested, if every $1,000 you got something, and it was
got some free lipstick for you.
Yeah, that's it. Yeah, well, it's all vegan approved. So you could actually get involved in it, but for the most part, like some of the deals, and you're not going to get access if you're an individual, sophisticated investor. You're just not going to get access. You could probably go to the incubators yourself.
Pitch nights. Yeah,
literally.
PwC, all the KPMG all do these pitch nights where they bring companies out pitching directly to investors.
Yeah, just rock up. If you're a sophisticated investor, or if you're not and you just want to go along, just go along.
There's no gates.
Just because people do that. Like I've spoken to over the years, quite a number of retired investors that all of a sudden, they're not working anymore. They've got a bit of money and they think, well, I want to get involved in these exciting new companies.
Yeah.
Just go along.
And help them out a bit too.
Yeah.
A lot of them work in the companies or try to provide them with guidance.
Well, they sit on like non-executive roles, as director. They might buy 5% of the company and support them through networking and whatever. And that's actually a really good way to get involved if you are an experienced person in whatever profession. You can actually go on and get involved with these younger businesses, and it's really exciting stuff.
Put some capital at risk.
Yeah. And you get better valuations, to be honest.
Yeah. Buying it.
Private market, early stage. Like you're going
massive risk reward though. A lot of, I think 90% end up not making it. So if you find ones that do, you're doing well. And then the other one, it depends. If you're looking at VC deals and it's all direct like that, if your advisors are otherwise a kind of conduit to the big VC strategies like the Square Pegs and the Air Trees, that's all basically done through the financial advice networks now. It's very difficult to get direct, and usually good advisory groups would have an allocation to the next fund that they can call on and distribute between their clients. I wasn't sure if primary market. Have you heard of primary markets? They're kind of doing this platform for unlisted and private company stock. Remember Animoca Brands? I think was on there. I wasn't sure if they're in VC or not.
That was listed,
and they got kicked off the ASX, and now they're like multi-billion-dollar valuation.
Really?
I think that might be an interesting VC way because, virtual gaming worlds, Animoca.
Yeah, they do blockchain games and Web3 and whatever.
Yeah. And it's a platform that you can use. I haven't looked closely at it, not recommending it, but it's just been popping up lately.
There's actually an article on the Rask website that actually talked about this because this was all the rage a few years ago.
Yeah.
So crowdfunding platforms are a big way to get involved in these small businesses. So the brand that I was thinking of before is Birchal.
Yeah.
Birchal, that's the one.
I bought some random things off there before, like the honey machine or the the beehive.
Birchal, Equitize, On Market, some of the names you'll probably know of. And there's this guide goes through how to get involved in these businesses. But it's really interesting. And you just got to remember that you are investing in very, very early stage businesses. A lot of them maybe not even have an office. So that's how early some of them can be. But by the same token, some of them can be Booktopia.
Yeah.
Massive. So really interesting stuff. I actually did an interview with Equitize early in the days when they just started. So it's actually on this channel, the Australian Investors Podcast. I'll put the link in the show notes to that guide on crowdfunding and the risks involved in Australia. But that's definitely the way to think about getting involved if you can't access the VC funds. Okay, here's a good one. Canadian Aussie, aka Trevor. Love the new format. What's been your favorite investing loser and what did you learn? A company you loved and maybe still do.
Can't have a favorite loser, can you?
With distance. But maybe, you've lost a lot in it. So
is this a psychology session?
This is coming into the this is the studio where you come in and you confess and
all your investment sins.
Yeah, I've got a few. So
I should put my hands up because it's like, catching falling knives would be my saying for every time I've lost money in the market.
Can I speculate what? Maybe this isn't your favorite.
There's 3.
I'm going to guess. Well, if you've got 3, I'm guessing one of them is Newix.
Yes, that's the first one.
Okay. What are they? Magellan?
Yes. If you get 3 out of 3, I'm walking out. I'm leaving. It's more recent. Last.
You said it recently. Zip.
Yeah. You got all 3. How did you get it? They're all down 85%. So, yeah. Thanks.
Oh, so good. Sorry.
And all of them after that already fallen 50.
Oh, right. So
that's catching falling knives. If there's a lesson from all of that, never catch a falling knife.
Oh.
In person and in market.
Yeah. Okay. So which ones of those, you got a few there, which one's your favorite?
I like Zip because I made money at it before I lost it.
Okay.
That was
Did you sell though, or did you just hold it and then?
I traded. So I bought it 50 cents, sold it $3, $6, bought it 3, sold it 10, bought it 6, still got it at less than 1. I did end up on top with it, but even that itself is a lesson that when things like this are running, take profits and get yourself to basically a no loss position if you're going to play in this stuff. And the other lesson is stop losses on non-blue chip stocks, always.
Mm. That was a big lesson from a lot of investors out of the GFC, obviously.
Particularly on
losses.
Particularly if it's outside the ASX 100.
Yeah. I like it. So
what was yours?
Well, if we're going to do 3, I'll share 3. Slater and Gordon has to be up there. That bloody thing. That's just, and the worst thing was that, and Slater and Gordon's a law firm in Australia for those people that don't know, and it went into the UK and then just blew up. Bought Quintus, the started with Q, I can't remember the
Quindell,
yeah. Quintus was the TFS Corp, the Indian Sandalwood.
That was number 2.
And thankfully I didn't get involved in that asset play, no cash. Slater and Gordon, the worst thing about it was this is when I was early in my journey and I was investing my mum's money.
Yeah.
And that was the biggest position.
It was 95%, wasn't it? Then you work out what a recapitalization is when that happens.
I bought it $2. I think she, via me, bought in at about $6. And I think it got to 7 and then fell.
Yeah.
So, and one of the risks is that when you talk about this stuff publicly is that people do follow you in, and that's the worst feeling.
Yeah.
That's why most good investors don't talk publicly about their investments because they just don't want to feel that weight. So that'll be number 1. I've had some real bad ones. Like Dubber's got to be up. Dubber's probably the worst mistake I've ever made for one of our membership services. Just because I was baking in, for 2 years, I baked in 30% top line growth with scalability kicking in, and none of those things happened.
No.
So if you went down my DCF and you went down the income statement, you could probably just put a cross next to every forecast.
Every assumption.
Yeah. So
what do they say about assume?
Yeah, that's Max and us of you and me. And the third one is this is probably the biggest lesson that I've learned on investing in high growth companies is actually I sold Nearmap.
Yeah.
And I sold Nearmap. It was by far my biggest position by actual investments.
Yeah.
And I sold that at 54 cents because I got impatient. And then it went to $3 or $4 because the only reason is I got impatient. And I just I was taking my cue from the share price. And I did the numbers one day and I realized that if by dollar value, by far the worst investments I've ever made are the ones that I've sold, not the ones that I've bought and lost.
Yeah.
And I think if you invest in a high growth way in direct companies, you need to be prepared that you're going to make a lot of losses.
Yeah, yeah.
but you must be prepared to back your winners. Like you said, falling
Let it
knives.
run.
Yeah, totally different. But if you're going the other way, people get spooked.
Yeah.
And that's been my big lesson learned.
Yeah.
Yeah. Great question, Trevor. Canadian Aussie. Also on Strawman if you do want to check him out. Okay, so Drew, what we might do is we might have a quick break and then we'll come back after this ad. So Drew, we've got a question through from Aston.
Yes.
Is Aston a made-up name, or is I feel like that?
I think it feels like it could be real.
I think that could be real.
car.
Yeah, that's pretty cool. Do you think Ray's ASX RZI is a good investment? I noticed the share price at 53 cents currently is close to the lowest it's been, and it's something I regularly use and invest in. Oh, I didn't see the second part of this question.
Yeah. This was loaded.
I feel like this is planted. Question goes on from Aston. Also, I bought Zip shares at $3.75. Sorry, Aston, I don't mean to laugh. I want to.
You didn't buy them at 6, so it's all right.
Yeah. I want to sell these. Should I wait till the price goes a bit higher, or best to sell now? I only bought 120 shares. Well, you've given us a lot of information there, Aston. Just so you know, we cannot answer this question specifically for you. So we're just going to answer, generally speaking, about the companies. Just so you know.
I bought it at $6 and I don't even think about it anymore.
Do you still hold it, or did you get rid of it?
I still hold it, but I just don't think about it anymore. You know where you
67 cents.
Compartmentalize things that happened in the past? Zips in one of those compartments and in the bottom drawer of my portfolio.
Yeah.
You never know. Someone's probably going to buy it. Who knows? At some point.
$12.35. Still found a run. Has been the whole time. It's obviously the key risk is that it's built an empire locally and overseas, made a lot of acquisitions, and share count went up, way up. So market cap is still $464 million. In a tough economic environment, Australia, overseas, it's going to be hard for buy now, pay later businesses. They could try and increase prices, but then they might ratchet up more bad debts.
Yeah.
So Afterpay is the one that definitely got away with the deal by selling into block. I mean, if you have something, so your answer to this question is basically, if it's so small, you've lost it, you just leave it there.
Just leave it. Someone will buy it, so you don't have to worry about brokerage.
Could you? Okay, here's the question. This is not like, we're not in any way saying this is specific to anyone, but could you sell it, lock in the tax loss, if you had that theory?
Don't buy it back.
Then buy it back. That's what I was going to say.
One, that's potentially tax.
It's not
avoidance.
It's not Division 4. I'm just doing it because I like to trade.
Sure.
So Division 4.
I just got to make a call. Are you mentally able to deal with seeing that every day? If you aren't, get rid of it. That's like in my portfolio. It's like if it constantly reminds you of a mistake you made, we've all got that in our lives at some point. You just cut it. But if it's not, then and you don't need the money, well, why bother? That's not even thinking about the company. You can talk about how great the company could be, but it's got as many risks as it has opportunities. So when it's that small, we just kind of personally, this is not advice or for clients. You just leave it.
Yeah. Yeah. Division 4A, just so people know, is when you make a decision to do something and it's only for tax purposes.
Yeah.
So people do that when they sell.
Tax loss selling.
Yeah. I've got a feeling, it's a very up there suspicion that people still do it anyway.
Yeah.
Yeah. But
don't confirm or deny.
Yeah. The other part of the question was RAIZ, R-A-I-Z. Is it a good investment? I noticed the share price was 53 cents. This was submitted about a week or two ago, so I'll just check that. But RAIZ, what does it do? RAIZ does, it's the original Roundup app. It was called Acorns here in Australia for quite a while. It's got a co-CEO model now. There was a bit of a board spill last year, and this is the thing about RAIZ, Drew, and RAIZ is a business that you just tap and go with your phone. You pay for your chocolate at Safeway or what's it called, Woolworths, and you round up 50 cents. It goes into an ETF portfolio.
Yeah.
Really simple model. The competitor to this was Spaceship, and Spaceship looks like it nearly, can I say it? Like it looked like it nearly blew up.
Yeah.
It fell like I think the portfolio that it had invested, it was the difference between Raise and Spaceship is
They were a super fund as well.
yeah, and they were active.
Yeah.
And they had basically no fees. It was like a lead gen tool to get, I think, into the super product.
Yeah.
Whereas Raise is stuck in the realm of we just take your money and we just invest it into an ETF portfolio for you. Now, I think Raise is a really interesting business, but full disclosure, I've recommended this business in the past and it's down 71% in a year. The reason why I think Raise is an interesting business is they've managed to do something in finance that basically none of the other brands have figured out, which is how to get customers, and in particular, how to get retail customers.
And keep them loyal,
Yeah.
which is a massive challenge.
We're talking like...
They went to Indonesia too.
yeah, they're in Indonesia, Malaysia. So Raise was originally called Acorns, and Acorns, for many of you will know, is the US brand of this app, right? But George Lucas bought basically the intellectual rights to Australia, Malaysia, Indonesia, and a couple of other places. And the idea is that he basically got the technology and the idea, the branding, and that's why it rebranded to Raise when it became listed and done all this sort of stuff. And I asked George about this maybe a year and a half ago. You know, are you dependent on Acorns in the US? Like, what happens if something changes, if they get annoyed with you or something like that? He said, to be honest, most of the code now has been rewritten and we've written over the top, and it's basically our own app. We maintain it ourselves. And the thing about Raise is it makes money through a few different ways. It charges a monthly fee or an asset management fee, like 0. whatever percent. But increasingly, they're doing things like they have Raise Rewards, which where you join the app, you might get insurance.
Some benefits.
Like the Macquarie Marketplace. Yeah, that type of stuff. The average balance of a Raise account is between 3,000 and 4,000. And that's up from between 2,000 and 3,000 about 18 months ago.
Yeah.
And what makes this really interesting is that they have $1 billion of FUM.
Yeah.
That's not
pretty big.
That's not a small business. If this was a pure funds management business, you'd be like, wow.
It's pretty good size.
Yeah. But it ain't. It's a $46 million company at the time of recording. And I don't know. I just think that there's a lot of latent pricing power in there.
Yeah. They can ratchet it up.
Yeah.
My concern with these is always going to be that what's the catalyst? Is it that pricing power? And there's so much competition. They've got a good stake in the ground, but can they dominate? Do they need to go out and buy some of the other ones? Is that what happens? It seems like there can't be too many winners in the sector. And then the problem is you have a heap of competition that keeps the fee pressure lower. Other people are doing it for free or cheaper, trying to get customers. So it's always about what's the catalyst when I look at that sort of thing.
I agree. My thesis was initially that they don't lose customers, but they can increase prices if they want to.
Yeah.
And then the overseas businesses were basically just optionality. Yeah. But what's interesting, I think, is when they increase prices, they've done it twice off the top of my head now. So they went to, I think if you get a custom portfolio, something like $4.50 a month. When they increased prices, it didn't really have an impact. A lot of people were saying, oh, no, I quit and I went to somewhere else. But I'm like, to be honest, I think there's still pricing power in here in the sense of if you've got $3,500 in your Raise account, it seems to be working for you. You just let it go. I think if they send you a letter and say we're increasing prices by $1 a month, I just think for mental accounting, you think $1 a month, I don't care.
Yeah.
But then that could be a 25% uplift in revenue. You know, and that's how I think about the economics of the business.
Yeah.
But like you said, a business with a competitive advantage can't just have sticky customers. It also has to have pricing power.
Yeah.
I feel like it's been tested a little bit, but we'll see what happens to the business going forward. Brendan Co-CEO is on Twitter. If you want to follow him, good follow. That's Raise. So I think it's one for the watch list. In summary, that's what I'd say. I think it's one for the watch list. Interesting business. It's got work to do, but interesting business. Okay, Drew, I know you are all about this. So this is Joe Adelaide. G'day, Joe. If you are in Adelaide, g'day. He says, hey guys, love the podcast. Just wondering what your thoughts are on core lithium or smaller cap lithium stocks, proving to be quite a volatile space at the moment. Cheers, guys.
Always going to be volatile. Commodities in the market that's going on at the moment, and lithium's been on probably it feels like the last 5 years. It's just been on a up and down constantly. It's like almost say almost double. Did I say double cyclical somewhere? That you've got like the almost the momentum in pricing and discussion on lithium and batteries is completely different to the actual commodity price that they're receiving. And then you've got the challenge that I'm not sure about. I don't know a lot about core lithium, but I think they're still exploring. They're not
I don't think
at production yet. They're not like Pilbara that are full production.
Yep.
I feel like a lot of this is generally momentum driven, and people start following them when they're going up, which makes it trading stock, each to their own. But I'm more likely to hold something that's producing and pumping out income and has the ability to go and buy core lithium and expand their own business, where you can plot the risk return potential of it a bit better than this, because this is kind of a double hope, isn't it? That you're hoping the lithium price remains high, and you're hoping that their production and everything they do, they can raise the capital that they need, or they can get to the production they expect to be able to get to.
Yeah, it's a bit earlier stage than Pilbara. Nearly $2 billion market cap. When I pulled the numbers on this a while ago, it was actually in the top 10 performing companies over the past 10 years.
Definitely.
Just because it had gone from, basically nothing. What was it? In 2020, it was 4 cents, $1.10 now. It's quite early stage. And you've got Pilbara, which is a big company now, north of $10 billion, that's chalking up a lot of free cash flow, incredible free cash flow, how fast that's pivoted. And people are thinking, well, this could be the next Pilbara.
Yeah.
Same thing they thought with Lake Resources not too long before it. I actually had Kanish Chilgan on Self-Wealth Live this week, Wednesday night, 6 p.m. And
I had a beer with Kanish last night.
Did you? That explains it.
One beer.
Yeah, just one. Home early. I chatted to him, and the thing to keep in mind is that you can get an ETF exposure to this. The thing that we talked about was that if you are exposing yourself to the thematic, you're going to do, if you have a diversified approach to it, you're not going to do better than your best and than the best in the sector, and you're not going to do worse than the worst.
Yeah.
And in resources, you tend to get a lot of losers.
And there's a massive difference between the best and the worst in resources always.
Yeah. And so core lithium, I mean, it could be, if I play devil's advocate here, I could say that maybe for a very small part of a portfolio, very, very small part of a portfolio, I am still trying to get in touch with the CEO to try and get him on the Self-Wealth Live show. But for a very small part, the ACDC ETF was the one that I was referring to with Kanish, and that's basically the way I took that conversation is the ACDC ETF has exposure to lithium producers, to all the different kind of value chain as well, like from batteries through to storage, all that sort of stuff. I'd probably prefer to go with an ETF. Do you use it, ACDC ETF?
Yeah, we do. Particularly, it was very topical, I think, lithium a year ago. It's probably topical again. And just the nature of the clients, the way we provide advice is that if they're super interested and they want to be invested in that battery sector, let's do it in the most diversified and kind of direct way possible without taking that company, idiosyncratic company risk.
Yeah.
Where you can get 1,000% return or minus 90%.
Yeah. And the thing that tends to happen is with a lot of these companies that obviously lithium is everywhere. There's actually about a teaspoon in this iPhone here. The thing is, the thing that tends to happen is there tends to be a bit of a washout as well.
Yeah.
So you tend to have companies falter, and then you can buy them cheaper in a few years, or like you said, the bigger companies come in and suck those ones up.
Gobble them up, yeah.
Yeah. So that's like, we see that with BHP all the time, right? Trying to buy MinRes at the moment. Yeah. Next question comes from SPP Hunter, who asks about an SPP. On an SPP offer, should I sell all my shares before taking up the offer and replace them with the offer up to the 30K limit? What things do I need to be aware of?
Make sure you don't sell them before the X date.
Yeah. Yeah, that's probably good.
Make sure you still got the entitlement before you sell them.
Yeah.
Which is probably the first one. We have a simple rule in-house. If there's an SPP or a rights issue or a capital raising, we won't be involved unless the discount's at least 10% to the share price. So great companies will usually do it like 6 or 7% because they know they can get money however they want. It has to be more than 10%. And then you've got this arbitrage. We think 10% is enough for the kind of month or two that you have to be unable to sell your your new shares. That's the way we've always thought about it. And the other one would be, if you hold $3,000, don't apply for 30. Only apply for how much it could be a good arbitrage. Only apply for the amount you actually would be happy to hold afterwards. And for sure, sell if you know what you're going to get on the other side and you can make a 10% profit. Yeah, sell the other portion.
I would say one thing to be mindful of is also the tax situation.
Yep.
Yeah.
Capital gains.
Yeah.
Yep.
Because it might work out in the wash, so you actually don't make anything.
Yeah.
So just be mindful of that.
That's why you want at least 10. Then you think if you're paying, as most of our clients have no tax because they're in superannuation, so 10% is fine. But when you're in
accumulation,
30% tax rate or 15% tax rate, then you probably want 15% discount before you get involved.
Yeah. And I find that I get this question a lot when investors are probably 1 to 3 years into their journey because they see this and they're like, oh, just
free shares.
Yeah, free shares, yeah.
Or free money.
Yeah. Have you ever had a bonus issue?
Yep.
I had one back in the day. I think it was with Shine Lawyers. Speaking
Another one.
So that's a good answer. Great question because a lot of people think that. Honey Badger. Great name. Honey Badger says, what should I pay attention to with Blackstone Minerals reporting next week? I feel like we've received this after. We could do a post-mortem on this perhaps if it's already reported. How do you value a small cap mining company with no profit yet? They look promising, says Honey Badger. I don't even know what Blackstone. I mean, I should have looked this up. Normally, I do prep for these Q&As, but I don't actually know. Is this the US company? No, it can't be.
No, that's I had an issue with this for a client actually. That Blackstone, the private equity group, kept coming up in their portfolio with Blackstone Minerals.
Is it? Where is it? Oh, right down the bottom. Okay, sorry, I'm on the ticker terminal here, and I'm trying to find the thing. It's way down. Okay, so it's $82 million company. I don't really have an opinion on Blackstone, just because it's 18 cents a share. Engages in the exploration and development of mineral properties. It says. Do you know anything about it?
A client reached out and asked me to buy some for them.
What do you do in that situation?
Position size. Yep. Don't buy much. If you've got $1 million, maybe don't put more than 10 grand or something in it.
Yep.
Hold it appropriately. And then obviously it probably went up significantly after he bought and he wished I had told him to buy more. That's part of the job, is to take blame as a financial advisor. Super hard to value, if it's whether it's production or a exploration asset. So production, you're looking at all-in cost of production. What are the trends in the commodity price? What are people forecasting? And then one of the big things I see, it's not probably valuing it, but working out if it could be a good company. Shareholders who are aligned and have a history in these sectors can be incredibly powerful tools to understand what the prospects of that company is. It's like investing with other smart people or dumb people. It can be both options there. I think that's about all I can add. I can't. Yeah.
Well, yeah, some pretty crazy forecasts for analysts in the ticker terminal. I don't know. I don't know what's going on there. But what I would say is that a lot of these early stage companies, just be aware, Honey Badger, of where you get your advice from. So a lot of the reports that you will receive from brokers or from investment banks are written by brokers that do the capital raisings. So it's particularly for these early stage businesses, they need to build the hype so then they can pump their stock and then push new stock into the market and fund their operations. And that's, there's a few major milestones for early stage mining companies. You've obviously got the tenements or wherever they're exploring, how are they going to cover that? Then they've got, mining engineering and design, how are they going to cover that? And then they've got to actually build the thing. How much is that going to cost? What's the NPV on that? Who's financing it? Then finally in production, you've got to make an assumption of the cost base, which is usually based on the resource, how good it is, and then the commodity price.
A lot of assumptions.
And then you go further and further down that track, you reduce uncertainty, which is why you do see things like Pilbara Minerals that make it through those numerous hurdles. With every hurdle, it bounces up higher and higher and higher.
Yeah.
And every point is a probability. And I think best investors that I know think in terms of probabilities. And if you back that out, you get to a point where you find that the assumptions are too wild.
Yeah.
You just this is a 30% probability.
Downgrades where the asset, and then you get a new feasibility and it's 30% worse than it was before. Or
Yeah. Yeah. So you only need a hurdle. It's a 1 in 2 chance this is going to work. It's got a 1 in 2 chance this is going to work. It's got a 1 in 2, and you're down in single digits, right? So keep that in mind. Great question though, because the next question is basically the same one from Dan. When investing in a mining stock, what should I look at other than the financials, management, and commodity prices? Well, we kind of just
answered a lot of it. Directors that have been in other good businesses, I'd probably add to it. I said shareholders in the last one. And then almost location to other key assets. So you're next door to BHP, you're next door to Zinifex, or what are they called? Zinifex?
Yeah.
Oz Minerals.
Oz Minerals,
what are you near? And you're going to be able to get the production actually out at a reasonable cost. Yeah.
And this, Dan's actually, I think with this question, we just come off a bit more of a speculative mining question. This one is more of could be anything. So you could be talking about Fortescue, you could be talking about Vale, you could be talking about BHP.
Yeah.
And when it comes to that scale, it's a totally different question because these are sustainable businesses in the sense of their financials. What I would be looking at, as Drew, just echo what Drew said, is the management team. I think a lot of these companies have management teams that if you dug up the backstory, you'd probably be like, oh,
yeah.
So one thing that I would be looking at with every mining company, just because this is my risk-averse nature with it, is the cost base.
Cost of production.
You got to know what that costs, because that is what's going to determine the fate of the company. Because what happens is during the mining cycle, when it busts, the big companies like BHP that have super low cost bases, they are still cash flow positive, and they go to everyone and they look around and go, okay, who's struggling the most?
Yeah,
we'll take you. We'll take you. Thank you. And then they're just boosting their resource and reserves at the expense of other investors who have funded that growth.
Yeah.
So that's like Fortescue's all-in cost. I think last year was $15.90. And then this year, I think it's $18.50 odd. So, and they think it's going to go up a little bit more because of diesel prices.
Yeah.
So you got to then benchmark that against the iron ore price. The iron ore price has been very high for the past 3 years, but it looks like it's coming back down a bit.
Definitely.
So then you've got to bake that into your assumption. I think a lot of those big dividend stocks that are the miners, Fortescue, Rio, BHP, we're probably going to see lower dividends in the next 2 to 3 years.
Yeah.
Some of those.
There's cyclical.
Yeah.
Mining, it's always going to be like that. Thankfully, China's always bailed out our economy when it's happy. It's going to happen again. The Chinese economy is the only place in the world that's cutting interest rates at the moment when everyone else is increasing. So there's every chance to get another strong mining boom while the rest of the world falls into recession.
And it's priced in US dollars.
Yeah,
so that helps. Okay, Pippa. Good.
This one's an old favourite of mine too.
Oh, okay. This is the question. This is the second last question. I'm new to valuing stocks and loving your courses. Thank you very much, Pippa. Thank you for your work. I'm interested in getting an exposure to agriculture. I think there is a great long-term outlook for ag given the macro trends of rising incomes and population in nearby Asia region. In particular, I'm interested in the company Rural Funds Group. That's RFF. It's basically a company building land and water assets that are suited to beef, macadamia, and viticulture that they can lease to businesses to operate.
They call it a stapled trust, I think.
Yeah.
So it's a REIT or a real estate investment trust with an operating company.
Yep. My question is, how would you value such a company? Also, a broader question, why do you think ag's such an unloved asset class?
Should be interviewing Jamie on this, asking Jamie on this one, but I'll give you the cliff notes of this version. We loved Rural Funds, held it for quite a long time. We've actually got an unlisted version called Arrow that had a very similar portfolio of property. So essentially they buy agricultural property, lease it out for 10 or 15 years. I think the average lease on this one is 11.8, so 12 years is your average tenancy. Clearly that's great, and your vacancy is essentially zero because every property you have is always leased.
Yep.
How do you value it? This is primarily a REIT, so it's net tangible asset value. What's the value of the properties? At the moment, it's $2.69, or the last 30 June, it was $2.69, and the share price is
$2.29 now. Share price.
Yeah. So then, so what that's telling you is it's trading at a discount to NTA. So then you have to think, all right, does that discount to NTA mean they think the NTA is going to fall to $2.29, or is this a buying opportunity? And then, if you really want to value it, what you'd probably go and do is go look at, you can see what valuation they're using for each property. So what the cap rate is, which is equivalent yield, and you can find out if those properties have, if you think they're valued at 5.5% yield, but the rest of the market's trading at 6, well, they're probably going to go down in value. If it's the opposite, well, they may actually be set to increase in value. So net tangible asset for this type of group always.
Yep. As it definitely is like a heuristic, makes a lot of sense.
Yeah. They got hit by a short seller a few years ago.
That was like 2019. Yeah, 2019 fell from $2.38 down to $1.69. And I think that was based on overvalued assets.
The issue there, not the issue, it's quite a unique structure that the management company is, the stapled trust having the management company there. And some of the assets are leased from memory to Rural Funds Group, which is a separate group. Yep. That is also the manager. So they were saying that there could be some operational risk there if the same tenant is sort of owning and leasing and operating it. That's what they said. And there was a bit of opacity, so you couldn't tell exactly what was going on. Whenever that happens, unlisted assets on a listed market, short sellers always look at that and lick their lips.
From memory, this wasn't long after Blue Sky as well.
Yeah, it was the follow-up to Blue Sky.
Yeah. So...
why not ag?
Yeah, why not ag?
It's probably more cyclical than commodities, you'd have to think. The issue with agriculture, probably the same as commodities, is that it's low volume. It's not low. It's low margin. Growing lettuces, you have to grow a hell of a lot of lettuces to make money.
Yeah.
So groups like Costa will have an incredibly great period, and then they'll have a bad crop season. Then they have these other accounting rules. You've probably seen Sagara. I think Jamie probably spoke about that. Where you have to increase the value of so if you've got salmon, you have to increase the value of your salmon on your balance sheet as the salmon grows. But if it doesn't keep growing to the size you expect, you're paying tax on the way up. So you get these kind of lumpy changes in your asset base, and you're paying tax on income that isn't quite there yet. I think it's just so seasonal, and listed equity markets aren't suited to very, very long-term views. Agriculture, you need to think about it as 10 years.
Yeah.
And you have one bad season, your share price could fall 80%, and you struggle to raise capital.
Yeah. Well, that's I used to follow the business quite closely. I don't anymore. Jamie Nemsis appeared on the podcast recently in the masterclass as well. What was the family farm?
Yeah.
Was it almond? No.
Sultanas.
Sultanas, yeah, right.
So your margins are like 8%.
Yeah, right.
Profit margin, something like that, which is incredibly low. You have to do a lot of volume to make any money.
This is a really interesting business, though. Sorry, just to change gears again. Because the thing that I've liked about Rural Funds Group is you don't have to actually own the most cyclical parts.
Yeah, it's like infrastructure.
Yeah. I think that was like Ruralco, quite a few years ago. Even Elders figured that out and kind of went into property and had all these different business models within the overall business.
Yeah.
And I think that's the key here is you get exposure to agriculture while also, having the protection of not super cyclical revenues.
It's perfect for retiree portfolios. You're just buying another version of property.
Yeah.
It's hard to buy agricultural property in a smaller space. You just want to make sure the value you're paying is fair.
Yeah. And when you get to this, and another thing that happens is a lot of property, right, is intergenerational. The best property is intergenerational. Yeah. So you do need to scale often to get good properties.
Yeah.
So interesting. RFF is the ticker symbol. Finally, Sam says, I have 100K coming up. Don't know how to save, protect and grow it. Very simple question.
Very simple question. And it'll always go back to what's your objective. Are you saving, protecting, or growing?
Yeah, I mean, there's three there.
I'd probably say do a bit of each. So, without knowing you personally, you probably want to put some money away for emergencies, work out how much you need for emergencies, how much can actually be invested, and then what your objective is. If your objective is to grow it significantly, then build a lowish cost portfolio of assets that you don't have to think about.
Yeah, I like it. I would say maybe 100K in this market, the last thing I would want to do is just whack it all down at once.
Yeah, definitely.
You don't want to do that. If you're thinking, like I get this question a lot. I got a question the other day, wonderful question. Someone was selling an investment property, basically all paid off. It was a lot of money, in the hundreds and hundreds of thousands, and they wanted just to put it all down at once.
Yeah.
Which is fine.
We don't even do that when we get new clients now. Yeah. We'll step in to new investments over a series of months.
Yeah, and yeah, it's fine to think that, oh, well, I've got to invest and this money's going to be dead money, but you can just park it in the bank for a little while and some interest.
You get interest now, 3.5% for a term deposit.
And then slowly just, trickle it into the markets, whichever way you want to do that. If someone walked up to me in the street and said, here's 100K, I don't know what to do, I would say, well, probably I'd fix the second bit before I tried to solve the first bit. Yeah, so maybe think, well, like you said, break it up. How much do you need for operating expenses in your life?
Yeah.
Then, well, if you can't save, you probably want to keep it out of reach. So put it in, you can use a term deposit or something like that in a different bank where there's no card attached to it. The other question is do you have high interest debt?
Yeah.
Don't be, when interest rates are going up, you don't want to have
credit card
and then be
personal loan.
Yeah. Get rid of that stuff. But after that, step one, build your base of your core assets. So those would be diversified, in my opinion, diversified investments, low costs, what you can understand, and just build out from there. Don't, like a lot of people get this and then they think, I'll go and put it in, what was it, Blackstone Minerals or something like that. That's the opposite way around. You want to start with your low cost options, build out.
Yeah.
If you had, if you had a little bit of money right now and you're investing for 10 years, just say, I don't know, and you just wanted to make one investment in your core portfolio, like you don't have to name names, but what would you be looking for?
I'd probably just buy Vanguard.
Yeah. Yeah, it's like Australian
Growth.
Shares or something like that. Vanguard Australian Shares ETF, VAS is the ticker symbol. Yeah, that might be one of them. I might go, you could even do VDHG, which is Vanguard Diversified High Growth.
Yeah.
That's where I would start. Get that exposure to markets, get used to it. Typically, a lot of our other podcast listeners on the Australian Finance Podcast, they might, instead of having 100 grand, they might have 10 grand. Yeah. And I say, and a lot of them are interested in investing, and I say, you know what, go and spend, I don't say this to them because I can't offer personal advice, but I just say, I'd put 9 grand into low cost ETFs over time, and I'd save the other 1,000 for individual stocks.
Yeah.
And then that way you don't feel like you're missing out on individual companies, but you also get the plan B, a pretty bloody solid plan B as well.
Yeah, completely agree.
Yeah. But it's a great question, Sam. If you're new to investing, probably go and check out our Australian Finance Podcast, which is the blue one in your podcast player. A lot of people listen to this podcast, don't know that one exists, and most of the people that listen to that don't know this one exists. We need to do a better job of marrying the two, but that one's definitely for the beginner to intermediate. This one's more advanced, and they'll be made apparent in the coming weeks as we have more experts on the show. But these are the questions for today. If you want to ask a question, be sure to head to rask.com.au or any of the Rask websites. Menu item, ask a question, select Australian Investors Podcast, Canadian Aussie, talking to you. Send us some more questions. I really did enjoy that one.
That's good.
Yeah, that's a good question. Lots of good questions today. Drew Meredith from Wattle Partners here in Melbourne, but does get around the country. Wattle Partners.
Too often.
Just come back today. Flew in for this. wattlepartners.com.au. You can find out about financial planning and get in touch with Drew. We are actually heading to Noosa.
Next week.
Is it next week? 2 weeks.
Sunday week.
Yeah. That is around about the 9th, 10th, something like that.
9th of October, yeah.
9th of October. If you are in and around Noosa and you do want to catch up with us, reach out.
Live pods.
Yeah, we're going to the Inside Network event in the Sofitel.
Yep.
Is that correct? We'll be doing basically a day of podcasting while we're attending the event.
Interviewing some financial advisors.
Yeah, and some consultants and VC and some other people in there. It's going to be heaps of fun.
Yeah.
But if you're in the Noosa area and you want to grab a coffee or something to eat, let us know.
Miami Vice, if you listen to my favorite podcast.
Hit us up. Yeah, we're in the area and it's going to be good. So awesome. Until next week, Drew, or the week after, or whenever we come back, probably next week. Thanks for joining me, mate.
Thanks again.